Our perception of money is changing rapidly, and banks are at the center of all of it. From how we access it, to how we buy, to how we trust that that money will be there when we need it. I'm Kiah Haslett, the creator of FinTech Takes Banking. Here on Bank Nerd Corner, I talk with bankers, economists, academics, and more about the complex dynamics shaping the financial services landscape. This week on Bank Nerd Corner, I'm joined by Brian Peters, a veteran of the Federal Reserve Bank of New York and insurance giant AIG. Brian shares his career path from a bank supervisor at the New York Fed to post-crisis chief risk officer at AIG to starting one of my favorite newsletters, Perspective on Risk. From there, Brian and I talk about the mandates of the federal banking agencies, the evolution of supervision to financial stability, and the 3 types of supervision he sees. We also discuss his strange experience trying to convince a large language model to use public data to predict bank failures. Hi, Brian. Thanks so much for joining me today.
Oh, it's great to be here, Kiah.
Well, I wanted to ask you to join me today because I am a big fan of your Substack Perspectives on Risk. And I thought that, I've learned a lot from you, both as a supervisor, as like a central banker, which isn't exactly the type of bank reporting I do. That's a whole different group of nerds. And then also just kind of your holistic look about risk, and where risk is building, not just in our financial services system, but really the economy and kind of the nation. Could you tell me a little bit about your career and how you became a bank supervisor?
Sure. I guess it started after grad school.
Okay.
Before grad school, I'd been a mortgage banker. And so I was selling monthly adjustable negative amortization mortgages down in Florida.
Oh, yeah, the good stuff.
So I went to NYU to get an MBA, and coming out of there, interviewed with a few firms. It was about 89. The market wasn't great. And I went to the Fed for an interview, and they take me into this nice, fancy dining room and wined and dined me. And
oh, cool.
I'd always had an interest in money and banking. So I needed a job. I had just gotten married. And so I was kind of pressed, and so I took it. I was probably the second or maybe third batch of master's level candidates that they were hiring into supervision.
Oh,
so
cool.
Before that, supervision had been something where, it was said you were born in supervision and you grew up. So you started at the lowest level and you were there for 40 years. And 90% of them were there, and it was, 80% male, 80% white male, a very old culture. We were brought in part to change the culture. I started out reading loans in the basement of a bank on Staten Island. That was my first job. This was after they had sold me on being part of this group called the Policy Studies Group, where everybody was flying to Basel, Switzerland. So it was a little mis-selling, we'll say, in the beginning. But I enjoyed the work.
Yeah.
And I got a number of steps along the way. I ran what's called the Shared National Credit Program for a while, and that's the review of the large syndicated loans around the country. And that was a fun time because there were a lot of bad loans. My claim to fame, if there is one in the supervisory circles, is a bank. You're so young, you probably don't even remember a bank called Bankers Trust. Bankers Trust was selling leveraged derivatives to a lot of their customers, including Procter & Gamble made the headlines in the U.S., but they were selling them to Indonesian corporates and all. And they were basically hiding the leverage formula and not disclosing things, not being transparent. And so we had a lot of interesting things going on there. And then I did a bunch of other stuff. I was in the Models Task Force, which came up with Basel II. So half of your audience now hates me already. And then, the last thing I did was, the big one, I think, the biggest thing in my career, I think, was 9/11.
Oh, wow.
And, because we had to move from the downtown fortress of the Fed and reconstitute and see how the banks were. And that was a crazy time. And then the global financial crisis.
Sure.
I actually took the call the day Bear Stearns was telling Tim Geithner that they couldn't open.
Oh my gosh.
I was on the phone, when Lehman failed. I took the call from Reserve Primary Fund when they announced that they were going to break the buck. So I lucked into it. I had a great career, and I enjoyed everything about it.
You went to AIG for a bit too, right?
So the Fed had, for all practical purposes, after Lehman had to bail out AIG. There was a large loan made to AIG. And at the time, there were two of us under Bill Rutledge who were sort of running most of supervision, Sarah Dahlgren and I.
Okay.
She ran what was known as the relationship people, and I ran what was called the risk people. And I remember Geithner came by the day after Lehman and said, okay, somebody's got to call the Europeans. We need to make the investment banks into banks. Somebody's got to do this, that. Oh, and somebody needs to go over to AIG for a day and straighten them out. And I remember turning to Sarah and saying, well, you're the relationship person. You go deal with AIG. That became such a massive undertaking. I basically gave her my entire leadership team as her direct reports to help bail that out because we had a lot of money out the door. So I wasn't involved in AIG very much. And I wouldn't even talk to them for a long time because we had a loan out to them. But then at one point, they paid off the loan to the New York Fed, and it became a loan to the Treasury. And at that time, I was getting frustrated with all the changes going on in supervision. They were blaming the Fed for everything that went wrong. And so it was time to look for another job. And I'd been there, and I needed to make some money. Finally, I was on a supervisor salary my whole life. And I knew Peter Hancock, who was ex of JP Morgan, and who was at AIG at the time. And so I went over and talked to him and said, Peter, I don't know anything about insurance. He said, doesn't matter. We need you. We got a lot of work to do. So I didn't go over there as the chief risk officer. I went over there technically to help them get ready to be Fed supervised.
Okay.
So I did a lot of implementation on that. And then I basically had every other kind of job. I was over the credit team. I was over the economics team. I was over the market risk team. I did everything within the scope of being a risk manager for about 10 years. I was 20 years at the Fed and then another 10 years at AIG. And that was fun too. I got a chance to put into practice all the stuff I'd been preaching to bankers for all the years, and it helped to get a little more commercial perspective on the world. Things that you don't always think about when you're a supervisor.
Yeah, and it's interesting because I wasn't sure. I know a little bit about insurance because of my time at SNL Financial. I was on the banks and thrifts team, but we sat really close to the investment banks team and the insurance team, and that made up the financial institutions group, or FIG. And I insurance seemed so fake. And I know kind of banking is also fake a little bit, but I was like, how it's regulated, and then how big the risk was at AIG, and to FSOC coming in and declaring Berkshire Hathaway and all these Berkshire's not a SIFI. They always apparently ducked it. But just hearing the insurance group talk, and I'm like, that's fake. You guys are like,
we could
and you're
do
like
a
big.
whole hour.
I know.
We could do a whole hour on that. What it did going to the insurance side forced me to do as a risk manager was go back to first principles. Because you had to rethink everything. So you had all the shortcuts in your head from being a bank supervisor and how they applied. But then you went back to look at insurance, and in many ways, many things were upside down.
Yeah.
Banks failed over a weekend. Insurers don't fail that way. They go into, they get controlled by the state, who then works them out over long periods of time. The nature of deposits versus the nature of their liabilities, vastly different. The nature of how the capital regime works, all vastly different. So it was really, actually, that was one of the more fun aspects of it, was you always had to go back and think about things from first perspectives. And then also in dealing with the Fed, their supervisors come in with their stress test, burn down analysis kind of thing. And you have to explain to them in some ways why that's not the biggest risk you have. The biggest risk is not that I'm going to have a giant run, in the next couple of minutes. So that was useful to go through.
Well, now you are retired and a newsletter writer. How would you describe your newsletter, and why did you decide to write one?
Um, so the interesting thing is, I had blogged all the way back to the days when I
Oh
was at
my
the Fed,
God, an
and
OG.
it was an internal blog for the Fed.
Oh,
Um, no, but it was. I mean, it shook up the place because
fed.blogspot.com.
yeah, well, yeah, because I was blogging and I was writing out to all the examiners, and all their bosses were looking at this shocked because I was telling them things about how to do their job or to go tell their bosses they're crazy. So I'd always put a lot of weight on communication and
Sure.
getting everybody on the same page. When I retired, this was more about keeping my brain active
Sure.
and keeping contact with many of my old colleagues. And it started out with about 80 people who I knew. And it's just me sharing my thoughts first about the financial system, and then it sort of grew to financial stability topics,
Yeah.
which I was active in at the Fed. And then it grew into even things like, climate risk and why aren't we paying attention to it? But basically, it's my thoughts. I don't monetize it. I don't care about it. Um, I I put it out there to provoke people to think sometimes.
Yeah.
So, and it's
So,
fun.
you mentioned a couple of your topics, financial stability, climate risk, which as an insurance guy, now that you're an insurance guy, doesn't surprise me. What are some other topics you find really interesting, and where do you find material?
Well, so the first thing is I write about whatever I feel like writing
Oh, okay,
about.
that's a good standard. Me
I
too.
don't have I don't have anything. The core of it is a bank supervisor's perspective. So when
Okay,
SVB was having its problems or all the reports were coming out on that, I spent a lot of time analyzing that.
sure.
And my take on that would be different from the press. So I would read what the supervisors did, and instead of just trashing them for not finding things, I'd say, no, look, they did a lot of things right, and they were getting there. But there are frictions in the supervisory process that make it slow sometimes,
Sure.
and they didn't fully get there. Or there are parts of the rules that they can't overrule. There's no capital charge for duration risk in the charge. And so there's limits to how much they can push on that.
Right.
So it starts there. It then gets into financial stability topics. That's, we'll get into this, I think, a little later. But one of the things that's interesting is each supervisor that's out there, the FDIC, the OCC, the Bank of England, anybody, how you approach supervision is in part based upon your mandate and how you think about the world. The
Mhm.
Federal Reserve thinks about financial stability. They care less about the failure of any one institution than they do about whether the financial system as a whole works.
Right.
As part of that, I discuss what I call my big picture topics 3 or 4 times a year. So I fundamentally have this mental model in my head of three drivers, principal drivers of long-term things. And those are demographics, and that's slow moving. There's globalization, which, we had a long trend of globalizing, and then the whole, are we deglobalizing? What's happening? Are we forming spheres now? And then the third is technology.
Sure.
And
Yeah.
technology is going, 17,000 miles an hour.
Right.
And that is upending everything. And then this year, just as a topic that came up, stablecoins came up. But how did I talk about stablecoins? I go back to my bank supervision and financial stability work, and I go back to even some of the papers of Jerry Corrigan wrote in 1982 on what is money and why are
Yeah.
banks important. And I tried to think about the stablecoin regime and what's happening through that kind of lens for people.
Yeah, I think that's really useful. And I did blow up your spot on one of your stablecoin pieces. So we tricked all those crypto bros into subscribing to a financial stability
Yeah,
newsletter. So
yeah, which is great.
more reading for them.
Yeah.
I think they could use some.
Oh, and how do I find
Yeah.
it? I read inordinately. There's still a technology called RSS out there, and I have an RSS reader.
Oh my gosh, do you still use RSS?
Oh yeah, I probably have 150 different sites load in every day.
Oh my gosh.
There are certain things that drive it. The FT drives a lot, Wall Street Journal, Bloomberg. But all these other sites, yeah, you pull them in and you scan it and you find the headlines that are interesting and you dive in. And one of the things I've always been told is that I am not a highly logical thinker. I don't go A, B, C, D. I am a lateral thinker. I am pretty good at like seeing connections between disparate things and saying, oh, there's something interesting here. How do we analogize this? How do we pull these together? What's the common driving factor between these things?
Yeah.
That's the thing that sort of gets my engine going a little bit. So.
Well, and not to praise the intelligence of newsletter writers, but I think the act of writing kind of hones that blade and hones that type of thinking.
Yeah.
And so if you have been writing for a specific audience for a really long time, and I don't think I'm like that smart, but I think what I do really well is I try to understand so I can explain, and that act of the task of learning something so that you can explain it to someone else in a way that helps them feel more confident and feel like they can make better decisions, which is, my guiding principle. I do think that actually helps you think laterally, and maybe, I don't know if it, I don't know actually if I think, from A to B to C per se, but I do like to say that I connect dots, or I pull threads, or I braid a thread or something.
It's funny. I have the opposite reaction to some degree. I like to teach, but teaching forces me to then be logical, to A to B to C.
Yeah.
Okay, let's go back to first principles. Okay, let's go back to the Merton paper.
Right.
And how does that, and what are the weaknesses, and what are the missing parts of that? And then how do you expand out from that? So, yeah, it may help you go laterally. It helps me go linearly, which is funny. But good.
Well, I've spoken to a couple of former regulators on the show already who have worked at different federal banking agencies. You alluded to the role of the New York Fed and the role that how the Fed is like different from other federal banking agencies. And I think we're kind of seeing some of that even today as we think about the role of the federal banking agencies and the deregulatory heads at them. What is unique or special about the New York Fed, would you say?
Yeah. So the first thing I'd say is anybody who worked at the New York Fed is fiercely loyal to the New York Fed.
Okay.
This will piss off
is it like the Harvard of banking agencies or whatever? You know what I mean?
My DC board colleagues, because we think we're the real Fed and they're just a monetary policy guys.
Oh, okay. They're just, yeah.
Each regulator is shaped by their mandate. And it was really noticeable in the financial crisis as you tried to negotiate things. The OCC is a chartering authority. There's laws. They're very attuned to that. They're very disciplined. They're very rigorous. They're very good about putting out transparent, here are the CRA reports, here is the guidance, follow it. The FDIC, an FDIC examiner comes at it from, I have to protect the deposit fund. Some banks fail, and we have to make sure that when they fail, we minimize the amount of losses and we make sure the insured depositors get out. The Federal Reserve, more broadly, and before I get to the New York Fed, thinks about financial stability. And, I think the whole Fed would agree. Yeah, and they have mandates to do small banks and large banks.
Yeah.
The way it's carved up is really stupid. Let's admit that. I'm not going to defend it.
Tell me how you really feel.
But so they think about financial stability. And the way I think about it is, when Jay Powell needs to pull the lever on monetary policy, does it flow through the banks, and does the credit get out to the financial system? And when it tightens up, what are the repercussions on U.S. banks, on foreign banks, and anything else? The Federal Reserve Bank of New York is a unique institution.
Okay.
It is a central bank in a way that none of the other Fed districts are to the same degree, and a lot of the other supervisors aren't, and even some other countries aren't. The New York Fed, like every other Fed, has an excess supply of economists. We have a problem, we throw economists at it. Great economists, some macro, some micro, some banking, some others, very specialist. One of the advantages of the New York Fed economists is they're in touch with the largest banks in the country. They have sophisticated thinking on these things. The New York Fed runs the wholesale payment system, the FedWire system.
Okay.
The New York Fed runs the markets desk. They buy and sell securities. They're in touch with the broker dealers. They have their finger on the pulse of the market. That was very useful in the financial crisis. We have a foreign central bank relations staff. So what many people know when they come to New York is the New York Fed has these vast vaults of gold, more gold than at Fort Knox.
Wow.
Except it's not U.S. gold. It's
Okay,
all
right.
foreign central bank gold. But because we have that, we put on courses for foreign central bankers.
Okay.
We regularly meet with them. The New York Fed has its own seat on the Basel Committee. So the Fed has two. They have their own seat. We supervise in the New York district the largest and most sophisticated foreign banks. We have Credit Suisse, Deutsche Bank,
Right.
the Canadians. So it's a very different portfolio of institutions even that we deal with in
Yeah.
markets. An example of how that plays out is following the financial crisis, we commissioned a group called the Senior Supervisors Group to review what happened in the aftermath of the crisis, what caused it. And we were able to bring together the BaFin from Germany and the Bank of England and the Bank of Japan and
Oh,
everybody else,
cool.
and put out a series of papers on how the liquidity things played out in the markets and all the
Yeah.
different risks. They're out there. I'd actually encourage people to read them. They're good papers. But that's the kind of thing that the New York Fed could do that comes natural to it that others don't necessarily do as well.
And it seems like it's like kind of history plus geography plus institutions that, you know, again, which is kind of geography, but it's I don't know if it was like what was deliberate and what was happenstance and what was legacy.
Yeah. So if you read, I guess it's not as much in the new 1929 book, but if you go through it, the way the Federal Reserve is structured is also kind of crazy, right?
Oh yeah, the fact that
there are
Missouri
these-
gets two feds, can we like? I'm
yeah,
from Nebraska, and that's an injustice
yeah.
to the Midwest
Well,
right there.
so there's 12 reserve banks there in Texas. You know, it's technically the Dallas Fed, but the Houston Fed actually seems to think they have their own.
That sounds like a Texas problem.
Yeah. So it's kind of crazy, but a lot of the structure of how the Federal Reserve was set up initially was to diminish the power of the New York banks
Oh, nice.
by having all these other votes out there that were
Yeah.
separate from them. And so there's a very unique political economy within the Federal Reserve System between the New York Fed, the Board of Governors and their staff, and then the other 11 reserve banks. And the politics between it shifts around a lot, and people form coalitions to support some things and not
Yeah.
others. Ultimately, it's a best ideas win culture. And, you know, you say there's politics, but ultimately, at least in my experience, it ends up as very good policy.
Yeah.
So.
And it is weird because it just seems like we have the same thing for, like, you could say the same thing about the New York DFS. They might be a more robust DFS relative to other states that don't have such complex banks or such big banks or such dense populations. And I know that, at least from the digital assets perspective, the New York DFS is seen as a very serious player in this space, but also a pretty innovative one. And so there are companies that selected incorporation in that state in part because of the supervision that they would receive. So it definitely makes sense, thinking about the Fed as, the institution and its legacy. And in the 1910s, where were you going to put these reserve banks? And you already had, even at that time, a large financial presence in New York. And it's like, it probably hasn't diminished that much. I know that Dallas and probably Salt Lake City wish that it was.
Well, I mean, Charlotte's got a critical mass these days. It's moved to some degree out of California, where Bank of America and Wells used to be. And so they've got a mass, but again, they have a mass of a couple of domestic banks, but the scale, Deutsche Bank and Credit Suisse are the size of JP Morgan and Citi. We also have the payment system banks for the most part in New York. You have the Bonies of the world, and we work we used to work very closely with the Boston Fed with State Street up there, who they have a very interesting portfolio of their own.
So when we spoke earlier, you said that there were 3 levels to your past job at the Fed. One was a bank examiner, where you learn how to examine a bank. Two
Yep.
was a bank supervisor who needs to know and understand why you examine banks. And then finally, the third level you ascend to is a central banker, and that
Yep.
person needs to understand how bank supervision fits into financial stability. And
Yep.
that flow made sense to me, but I had never really connected this like upstream or this like pyramid of supervision. Can you talk to me about this career path and the purposes, and then how this kind of flows and supports financial stability and really the economy that we have?
Yeah. So, like I said, I started off reading loans in the bank in Staten Island. And you're going to ask me later about credit quality, and I have actually an interesting little story there, how I've taken that forward. Um, but there's a lot of, understanding bank accounting, understanding how banks really make money,
Yeah.
as opposed to how people talk about how banks make money, is really foundational. And you have to do that. And there's other foundational pieces. There's a bunch of people who only do bank applications when they start. There's a bunch of people, and they're within supervision, who do the straight numerical financial analysis and ratios like you would find on Wall Street. But then, you have to understand how these pieces fit together. So why is the Fed against now? I forget, some upstate New York guy, Cattaraugus or somebody, who wants to take physical possession of property. Okay,
Okay.
why is the Fed fighting that? And so you have to put it into context of, okay, there are aspects of that are a different kind of risk that you have to just prohibit from the banking system, or you want to prohibit to prevent contagion and fallover and these other things. And you start to understand supervisory actions, you start to understand applications, you start to understand rulemaking, and how all those things sort of come together to make the banking system safe. And the banking system used to be the big kahuna, and now it's a smaller kahuna with all these other private
Yeah.
credit and all that around it.
The role that the banks play in the financial
Yeah.
ecosystem, for sure.
And then you end up thinking over time, and this is where I spend a lot of time now in the Substack, of thinking about, well, what is the bank's role in the financial system in providing credit? So banks used to make all the loans.
Mm-hmm.
Then investment banks created securities, and they don't do all the loans. Okay, but the banks then start funding the investment banks. Okay,
Right.
What's that connection look like? Okay, now we have private credit, and we have tranching of credit, and we have all these other things. But at the end of the day, all of those exposures, liquidity-wise, come back to banks.
Right.
If an investment bank fails or needs money, they have to come back to a bank to get money. They can't just come to the Fed. Maybe now they can because they're investment banks or they're banks. But everything ultimately comes back to the central bank to provide liquidity, to make sure things work. And one of the things is we went through the financial crisis, and the Fed gets criticized for this. But the first question I think that was on Tim Geithner's mind most of the time was, how is what we're doing going to support how Main Street gets credit? And the theory was, if we let the banks fail, the effect on Main Street from the lack of credit would be so devastating to the economy. So, everybody hates to talk about bailouts, but we had to basically bail out the system in some way, as transparently as possible, with as much market discipline and market money as possible. But it's still a bailout, in order to keep the economy working. Or think about how the euro markets were working and what, again, I said one of the things I had to do the day after Lehman failed was call up my European colleagues and find out what was playing out over there, because developments in the US banking market affected over there and how their economies perform and how that falls back onto the US. So you have to think about that. And one of the things I think that was most interesting coming out of the global financial crisis is, I'm not sure people, at least they didn't publicly articulate what they wanted the financial sector to look like after the crisis.
Yeah, they didn't.
No.
That's why we have jobs now.
Yeah, it happened de facto. They cranked up the capital ratios for the
Yeah.
bank. They made it unprofitable to do certain types of business within banks, and that led to the rise of these massive private credit lenders outside the banks. And
Yeah.
so we've sort of retranched the financial sector, where banks are still at the core, but banks are taking what used to be in securities terms called super senior positions, uh, and then you have the more mezzanine positions being held by other players or the
Right.
markets.
Well,
Um,
and it's, I think like your experience and career and time at the Fed was probably shaped by the financial crisis.
yeah,
I became a financial journalist in 2011, and I hadn't really thought about how the tension between like, hey, everyone needs a bank, but people hate banks in the US. Like that's
yeah,
a very poisonous, like toxic relationship. And then I wasn't really paying that much attention when Dodd-Frank was debated, but obviously my whole career has been shaped by a Dodd-Frank, post Dodd-Frank. And, there were elements of, Dodd-Frank, largest piece of financial regulation or reform since the Great Depression, and to wonder like, what do we want banks to look like? Who do we want banks to serve? What do we want things to cost? And I felt like there was so much like, well, we need to make the banks safer, and we also need to punish them. Like that, it's my
yeah,
read. That's my post grad read of this, and like that's weird too, right? Like we've decided. And also, like, we've also separately decided this is a private institution,
yeah,
but we have to we're just not gonna run it ourselves. Like we could have postal banking. Some countries do have an element of
yeah,
postal banking. We don't. But so we're not gonna do that. That's off the table. But we're all gonna do these other things. I always think like the world that's been shaped by even something like the Durbin Amendment, right? Like debit interchange. I don't know. I have no idea what was the debate around that. But like, I'm sure no one was like, hey, it's just going to change a bunch of the incentives for banks. And then it's going to change
mhm,
a bunch of incentives for tech companies that now understand there's like a revenue play here. And like, it is really weird that you kind of do have to understand both like how all these things connect, and then also like the balance of financial stability against these like large crises and who kind of gets saved, who gets and bailed out, and who gets left behind, and who and the fact that like all of this leads to people just like not trusting banks, hating banks, like whatever, right? Like we have like cryptocurrency in part because people don't trust banks, right?
yeah. If you think so, most people would like a small community banker. They still think about a bank and they think of George Bailey, and you go in and you know the guy. Most of our financial and just if I oversimplify the world, there's the community banks, and then there's capital market banks. And the capital market banks are, and how they operate to the average person is so complex and so opaque, they'll never fully understand it.
Yeah.
They may understand, okay, their mortgage has now been sold into a security, but they don't then understand that that security has now been carved up with certain pieces going to insurance companies and certain pieces, going to different investors who have different asset liability management needs, and
Yeah.
that all of this makes the market more efficient. And all of it, then that efficiency is what drives down the prices for them. The other aspect to it is, and I say this on the blog all the time, um, banks, while they are, private institutions,
Yeah.
banking as a whole is an extension of the sovereign.
Right.
When you're in a fiat system like we are, there's always some non-zero probability that things are going to fail and that the sovereign's going to have to bail it out.
Yeah.
It's just the way it is. That's the way it's set up. You want to minimize that. You want to the extent possible, um, keep private sector money in there. You want to avoid getting there. But essentially, during the financial crisis, the fact that there was the sovereign backstop for capital raises
Yep.
is one of the critical things that solved the crisis. And you need that in a fiat leveraged banking system.
Right.
And if you try to explain that to my aunt or uncle, they're never going to understand it. There are sophisticated people who don't understand it.
Yeah.
But at the end of the day, that's sort of how it has to happen, right? And you hit on another important thing, which is incentives. Banks are corporations, and all corporations are optimizing machines. You give them a set of incentives, and they are going to optimize to those incentives.
Right.
And the main incentive is, return to shareholders, right? And so, part of what solid regulation is about putting the right restrictions around that, so that it's an optimization problem, but it's a constrained optimization problem.
Yeah.
And the banks are going to always try and find ways to get out of that constrained optimization problem. And one of the problems leading up to the global financial crisis that happened over, I want to say 30 years, was banks coming up with arguments for why certain instruments should be considered capital that really weren't capital, right? And so you ended up with less real capital in the banking system and more debt that was called capital. But that's because that was in their incentive. They needed to optimize their return to shareholders or their return on equity metrics. And so they find how they can do that.
Sure.
And that's in part where supervision works with policy to say, hey, you know what they're doing over here? They're creating synthetic risk transfers. Is this actually getting the right capital treatment at the end of the day?
Yeah.
And it's not that it's bad to have a synthetic risk transfer. That's probably efficiency enhancing. But when it becomes a regulatory arbitrage, that's a problem. And you have that same issue in insurance. I think I wrote about that the other day. That people go jurisdiction shopping. Do you go to Bermuda? Do you go to some other place in the United States? Do you structure it in some way? And having some capital arbitrage is probably useful for the system as a whole. It's a little bit of grease. But having too much capital arbitrage is a bad thing.
Yeah. So you've written about some trends in supervision and articulated 3 schools. The first is risk-focused supervision. The second is compliance-focused supervision. And this third, which I don't know if I've ever seen as legibly as I do now, is politically aligned supervision. How do you define and differentiate these 3 schools? And how do they overlap at all? And are, and is one better or more effective than the other?
Yeah. I have a bias, and that'll shine through when I say this. And I'm not wedded to those titles yet. I'm still working out this thesis.
Yeah, sorry. Those are my names for your things.
Before I started in supervision, the supervisory process was backward looking. You went in, you looked at the ratios, a little bit of forward looking. You'd make them write off some loans. And there was an examination guide, and you went through the examination guide and you made sure they followed the things in the examination guide. In the 90s, we had innovation in banking. We had a lot more trading, and you had a lot of trading blowups. You had all these things. And so the philosophy in bank supervision changed from being something that was sort of backward looking, you just go by the ratios, to something that was much more proactive. And that was called risk-focused supervision.
Novel.
And it was, how do you make sure the firm itself has in place the right feedback loops, which is what I think mostly risk management in a bank is. It's just a separate feedback loop for the CEO. How do you make sure they've got the technology they need to monitor the positions that they're putting on and do it? How do you do all these other things? And it's a more proactive type of supervision where you have examiners who are looking at these things and sometimes looking across banks and saying, hey, really the kind of risk you're taking here, you don't have the systems to do it. Bankers Trust did not have the controls necessary over how their marketers were selling leveraged derivative products. People did not have trading controls in place, when that. And so that's what I'd call risk-focused supervision, and that's been the trend for a decade.
Yeah.
And I think it's overall a good trend. Um, my politically aligned supervision just came out of the recent speech by Mirren called "Regulatory Dominance."
Okay.
And before that, there was an SR letter that came out from DC for the Fed instructing the examiners in the various districts about changes in philosophy that were coming with Bowen in charge and all that. And that, to me, when I put both of those together, it looked like, and it still looks like to me, a very strong attempt by the policymakers in DC, the Treasury, the Trump administration,
Yeah.
to have supervisors back off, to let banks be banks, let banks take more risk, let banks extend more credit, perhaps let banks hold more Treasury securities to finance the deficit. There were certain things about what was written that really can seem to influence the incentives examiners had. So we talked about bankers' incentives, examiners have incentives. If you tell, and the one that was the biggest to me was something I wrote called the impossibility standard. They told the Federal Reserve supervisors that you must rely on the work of the other agencies unless it was impossible not to do so. Now, that's a very high bar to get over. And so that sort of means if you see something that you don't like, you can't go look at it. You have to, if in my take, and I hope I'm wrong, you have to rely on the OCC or the FDIC to have looked at it.
Yeah, you can't, you shouldn't be double checking someone else's work.
Yeah.
Or checking out yourself, I guess.
It's not necessarily, usually it's not double checking, it's just a different take on things. It's they looked at it in this direction, but they didn't think about looking at it in that direction. And it's usually more nuanced. And I see that, I've seen that throughout the world. I did some teaching for the Reserve Bank of India. And I remember one of the guys came in, we were talking about risk-focused supervision, and he goes, okay, but how do you give this feedback to the bank when the man who owns the bank is also on the board of the Reserve Bank of India? How do I do that when he's the leading politician in the country? And my answer to him was, you don't. You don't want to get fired. There's limits to what you can do as an individual examiner. That takes courage from the top to say what we're going to do. And so I think there's a real error right now of regulatory forbearance. When you talk about credit quality, the thing I was going to say when I got to that was you actually sparked me to do some work. And so now I'm going back to saying, why haven't we seen the commercial real estate losses that we expected to see?
That's a $1 million question there, Brian.
Well, and there's an answer to it. Back in 2002, 2003, when the CECL guidelines came into place, they did away with something called troubled debt restructuring.
Oh, yeah.
And that used to be a tally of all the cumulative amount, balance sheet amount of how many bad loans you had sort of restructured.
Yeah.
And they replaced that with a new acronym, I forget what it is, but that's more of a flow measure. And it reset that to zero. So you really don't have to disclose that anymore. And then the supervisors came out with an SR letter that encouraged the supervisors to work with their bankers.
Yeah.
And,
that's because it was COVID though. Like CECL went into effect during COVID, so they had to suspend TDRs to get all the modification, right? Because that was the incentive, right? Banks were not going to modify if they had to report them as TDRs or whatever. And so they kind of back-ended and were like, well, the TDR is a little redundant because we got kind of rid of some of the things related to with incurred loss reporting. I mean, I get it, but
banks engineered their way around it.
Yeah.
Instead of expanding the definition to capture the games, they, and so, but that's still going on.
Yeah.
And there's a way to infer how much of that extend and pretend is still going on in the banking system, which I hope to write about. And hey, supervisor colleagues out there, maybe it's time to do away with that guidance and get serious about reading loans again and making banks write off their losses. So there.
Yeah, I mean the issue, it's the Cecil had the worst timing because it was COVID.
Yeah.
There was
Good
so
idea,
many more,
bad timing.
so many more things that were important. But I do actually feel, and it kind of like did the job for COVID, but COVID is a very distinct type of loss event, or but Cecil needs to work in like normal environments, and just because you've front loaded all your losses doesn't mean like, hey, that's the reporting. Like there probably needs to be some more reporting the way that we had with the modifications.
They also watered down the Cecil standard quite a bit. I was in charge of implementing the Cecil stuff at AIG when we were doing it. And that got watered down to where you can, if you want, if you're not a good banker, you can play games.
Yeah. Banks have been playing games with their allowance since time immemorial.
Well, but that's part of an examiner's job, is to go in and, I don't call bullshit. I don't know if we can say that on here.
I can assure you, no children listen to this podcast. Whether or not my listeners will be offended by that.
There's not somebody who's dying to grow up to be a bank examiner? Come on.
Okay, so I do briefly want to ask you, because you alluded to it, with politically aligned supervision, Bowman did mention that she's looking to downsize Fed supervision staff by 30%. Everything that I know prior to this announcement indicated we don't have enough supervision staff. We don't have enough examination staff. The FDIC's OIG has come out and said that there's like a wall of retirements that might happen in the next 2 years. That there's a higher than normal like dropout rate of trainees. I just was not under the impression that the biggest problem facing any federal banking agency was there were too many examiners. What should I think about that, given what you've said about politically aligned supervision and the importance of bank supervision as it supports financial stability?
Yeah. So first of all, I think technically she announced they were cutting 30% of the board staff of supervision. But that's just a signal.
Okay.
When you're not, at least that's how I would read it as a former New York Fed supervisor who had staff. And I read that as saying, when we come around and give you guys your budgets, we're going to expect to see similar size cuts.
Wow.
Along the way. Okay. And to be honest with you, some of the other agencies I think have already gone through a series of cuts.
Right.
I don't want to be out here saying too much or too little. Okay. It's a choice on a spectrum. It's a choice about how much risk you want to take. Right. I always used to ask my teams, and then a team, when we were doing this, let's say they had dedicated the equivalent of 20 people to a bank.
Yeah.
And I would always ask them, okay, here's your plan. You gave me your plan for the year. Now, if you had 2 more people, what would you add? And if I took 2 people away from you, what would you cut?
Interesting.
And so it's always useful to see on the margin where their choices are made.
Okay.
And I didn't always think that adding was always the right answer.
Okay.
There was always, sometimes there was value in cutting, that they were looking at things or going to look at things that they didn't need to look at. Okay. In their plan. And they always had a harder time telling me what additional things they would look at than what they would cut. Now, if it gets into how frequently you're looking at banks and things like that, if you have to cut that back, that might be a bad thing.
Sure.
There was always these tensions around the number of staff for different banks. The recent trend, at least when I was there, was to put more staff into big banks, so the smaller banks got less.
Yep.
But again, it's a choice. Where do I want to risk missing something? Where do I want to risk a failure?
Sure.
So I think there's also room for regulatory consolidation. So as fierce a defender as I am of the New York Fed, the structure of the system is horrible.
Yeah.
I think Besson came out, I guess, in the spring of last year and said, no, there wasn't going to be regulatory consolidation, but I don't believe that. If there's ever going to be regulatory consolidation, it's a chance to do it now when
Yeah.
the Republicans have control of everything, right? They can force things through in a way they couldn't normally.
Hmm.
Um, and so there is some overlap, and there's things you can do away with. Um, but and given that I'm now 12 years away from actually being a line supervisor, 15 years away, whatever, getting old. I can't honestly say whether there's too many or too little.
Sure, sure.
Um, what I hope is that they're focusing on the right things,
Yeah.
right? Um, the optimal number of bank failures is not zero. We
Right.
want to catch the bank failures when you're a smaller bank at a reasonable time before it becomes bad. And a larger bank, we want to catch it early enough to have the right discussions with senior management about capital raising and changing things around and doing all the things you need to do.
Yeah.
So I think it will be cut. Um, I don't know whether that's good or bad. I hope they're cutting in the right places.
Yeah.
I sense, though, that this is just part of the agenda of let the banks run, get the supervisors out of their hair,
Yeah.
let them go make loans and make money. Because again, to the Trump theory of the case is we want to ramp up growth to pay down the deficit and the way to do that is we will handle any problems that occur after the fact. So
Yep.
supervisors, you just need to be backward looking. You don't need to be forward looking. Take the bridle out of the horse's mouth and give it a kick.
Yeah. So we talked a little about credit quality, and I'd like to touch on that as well as private credit. So credit quality within the bank space and then credit quality outside of the bank space. What are your thoughts about credit quality given your background in supervision? And do you, if you'd like to divide your answer between the bank space that has certain credit quality rules and examinations and whatever, and then private credit of which the banks lend to, some of these companies, of which include insurance companies, making their loans?
Yeah. So the first thing I'd say is, when I think about credit, I think about it in both ways. So from the financial stability perspective, I want to know about credit conditions and that they're not getting too tight and that credit's available.
Sure.
And from the supervisor perspective, I want to make sure that the loans that they're making at the bank level are well secured and can be worked out and all that.
Yeah.
When I last looked at the senior loan officer survey stuff, which was back in June, there are certain variables in there that are good predictors of forward demand.
Okay.
And when I looked at it it was August. When I looked at it in August, it said that for the next 12 months, there was going to be a normal credit environment in terms of the demand factors and the supply factors. So there wasn't going to be a problem. When I look at the markets right now, I see exceedingly tight spreads.
Okay.
And the question as an examiner I would have for the banks is, are you being compensated for the risk? And I would look for where is the leverage.
Sure.
You can have leverage at the investor level. So maybe the leverage, maybe I'm selling more to insurance companies who are more levered than pension funds. I can have leverage in the structures. Are the structures in the leverage going up or going down?
Okay.
And I can have leverage at the bank level.
Yeah.
Is bank leverage going up or down? And so if spreads are tightening, how am I making money?
Yeah.
Well, I have to make money by taking more leverage. And so where is that happening? And given where it's happening, again, what are my forward-looking controls? Do I have the IT? Do I have the policies and procedures? Thinking about the larger banks, again, that says look at prime brokerage, right? That's where the game is these days, or was until the recent changes again are going to try and let the banks get back into the private credit space. But it's the financial system has been increasingly tranched. The private credit space is just another tranching. They're taking losses. They can take losses. They can play games with losses. I think I wrote up about BlackRock Realty or whatever, Bright, and some of the games they played to gate their products and
Yeah.
essentially for some losses. And that can be a good thing. Again, I think it can make the system more efficient. But you then have to know, okay, when it does crack, how does it play out? Is there a liquidity demand coming from Bright to one bank? Are there one of the main things from the global financial crisis were the thing that caused Citi problems was they had these liquidity backstop lines. Essentially, they executed that. They claimed weren't liquidity backstop lines internally. They had come up with some other thing for it, but it really put all the exposures back onto Citi's balance sheet.
Nice.
So where are things like that are out there
that
will come back to bite you? I don't have a fundamental sense that things are bad, but we haven't had a real recession in a while.
I know.
So, things will come. Banks will fail. Hopefully, it won't cause a systemic distress.
Yeah.
One of the other things I've learned as a bank supervisor, and you can even see this through the financial crisis, is generally banks are pretty robust, even though they're leveraged. You can hit them. You have to hit them 3 or 4 times before they're really in a problem.
Yeah.
And so they'll be able to survive whatever's going on if it's just a simple credit thing.
Yeah.
Yes, their returns will go down and all these other things, but they'll be able to survive it. So I guess I'm not particularly worried.
Yeah.
Although your question is making me dive into the data a little bit more than I have recently.
I'm just a pessimist, and I've been waiting for far too long for credit to crack. And honestly, I would feel better if it cracked. You know what I mean? Like, the longer it goes on, I'm like, I think the pile's getting bigger. The crack's getting bigger. So
that's exactly why you've now got me looking into what is the extent of the extend and pretend, and how much of it is still out there, and where is it, and so because if you see that, again, a bank supervisor job is, or it used to be before the Fed's SR letter, was make banks write off their loans, and that makes sure the capital account is clean, so that when you're looking at your capital ratios, a 10% capital ratio is a 10% capital ratio.
Yeah.
It's not really an 8% capital ratio.
Right.
And so I want to think about that a little bit.
So my last question for you, and we're going to go a little long so I can talk about this, is that in one of your newsletters from August, you shared a really interesting interaction you had with using large language models in your newsletter. Yeah. For listeners who aren't familiar with what happened is in September, the year prior, Fed researchers had published research that argued bank failures are highly predictable using simple accounting metrics from publicly available financial statements, including call reports, which are public. You recreated this model and then tried to test it on current FFIEC data and then asked 3 LLMs to replicate the paper and give you, quote, the banks with the highest probability of failure in the next 12 months. Can you tell me what happened and WTF?
Yeah. The fun one was Gemini.
Okay.
And so one of the things you learn when you work with each of the LLMs is they all have different ways of working. And Gemini has a big workspace that it can do calculations itself for you. Okay. It can run regressions. You can give it data. And so I gave it, and I asked it to replicate the paper. And the paper's called Failing Banks for anybody who wants to look at it. And it quickly came back to me with, yeah, we can replicate this. Here, I did it. And I'm like, wow, that was great. That was fast. Took 20 minutes. So I'm like, super.
Oh my God, these AI models are all they've been cracked up to be.
Yeah. Then I started digging deeper and deeper and deeper. And I asked it to give me the top banks. And it listed a bank in Huntington, New York, where I happen to live, that I'd never heard of. And so the more I kept looking at it and then asking it questions, I found out it was just gaslighting me. It just blatantly made up the
What?
information. Yeah. Said, oh, well, these were representative. And yes, we had to hide the name. I said, okay, well, tell me the real one. Oh, no, I can't do that. I have to hide the name. It would be unsafe for me to tell you who the actual bank is. And so it kept going down these, excuses
That's
that I gave up
crazy.
on. But then I used another large language model. I actually started working with ChatGPT, and they can't do it themselves, but what they can help you do is write computer programs that will do it for you.
Okay.
And I spent a lot of time replicating the paper using their model, and it took a lot longer. But most of the problem wasn't
Did it lie to
developing
you
the
though?
model. Most of the problem was actually getting the information out of the FFIEC and
Mm.
FDIC websites. They are not structured to do this easily and efficiently and in a modern way.
Brian, you
And
need
that's
to
another
request
thing.
a Cap IQ press access.
Yeah,
So you get the
they
you
have
get
to
the
they have to fix all
yeah,
that stuff.
API.
And I'm finding that now as I'm trying to again predict where the extended pretend is going on. But I was able to satisfactorily replicate, not to perfection, a large degree of their paper. And
Okay.
yes, the average bank has a very low probability of default, and even the ones that fail, if you look at them, 2 years in advance, have a low probability of default. They'll look weaker,
Sure.
so the default prediction really, the power of it really picks up in the last year. And
Mm.
given delays in reporting and all those things, it really makes it a very short window where you have true insight into the failure probability. But you can discriminate rather easily among good and bad banks out
Sure.
to at least 2 years.
So Gemini lied to you for no reason?
It said it was doing because whatever I did would be, if I would publish that, it would be unsafe if I listed the banks that were weak.
Wait, okay. But
So it's
in your result, it doesn't even seem like it. It seems like the results hold, but there just aren't that many banks, right?
right. Yeah, and as you could see at certain points there are a lot of banks. So during the global financial crisis,
Sure.
and during COVID, the spike in the number of banks with higher default probabilities, default probabilities that started to get up into the 5 to 10% in a year were, spiked.
Yeah.
So there were the real probabilities there. But yeah, it just gaslit me totally.
I think I just couldn't. I don't want to say like I don't want to anthropomorphize these LLMs, but I was just like, excuse you, this is publicly available data. Whether or not it's in the safe, like whatever BS reason you're saying you can't give me this is publicly available data. And like, I'm used to like the Texas ratio, right? I worked at SNL. Yeah. We would publish the Texas ratio. One of the reasons why Travis Hill won't tell us how many banks are on the problem bank list is because you can kind of reverse engineer it by the quarterly moves.
Very easily.
And like that's just kind of the game. I hate to tell you that. We have decided banks are subject to a regime that requires an element of transparency by which we get to predict their failures, I guess. But
that we talk about that as financial stability supervisors all the time, the role of transparency. And frankly, the banks are much better than the insurance companies.
Oh, yeah.
The insurance regulators need to get their act together and create at least an FFIEC equivalent.
Well, I think about that like not all the time, but like kind of a lot, and just being like, that was so weird that Gemini did that and made up bank names and then like gaslit you about why it couldn't give it to you. And
I was ranting back at it with all the same things you're saying. I'm like, but this is publicly available information.
I'm sorry to hear that Gemini is not committed to, full transparency and public records the way that you and I are. So
yeah. Well, and it helps to build it yourself because then you can actually see too.
Yeah.
But yeah, don't trust them. I mean, they're great.
Oh, you don't have to tell me twice.
I use them every day. I am one of the most prolific users of them probably out there. I'm on all the pro plans. But, they always have the little warning at the bottom saying, this is an AI. Please check anything important. that's an important caveat. You know, trust but verify.
Please make sure the bank exists. Oh yeah, trust but verify. I've heard that before.
Make sure the bank exists.
Well, Brian, thank you so much for joining me today. I had so much fun, and I look forward to reading your what you find on extend and pretend credit quality.
Yeah, a lot of fun. Happy to help out with your audience. So.
All right, thanks. Thank you for listening to this episode of Bank Nerd Corner. Stay up to date with news and trends in the bank space by subscribing wherever you get your podcasts. Also, if you love FinTech Takes Banking, please tell a friend. Talk to you next time.